This is Module 9 for Accounting 3110, and the subject for this module is going to be joint cost. We will see in this subject that this is just really another study of allocations, and we will come back to that in just a moment. Let's go ahead and look at the for practice from Module 8C, which was about FIFO in process costing. In the for practice module C, the first thing I asked you to do was to work on step 1 using the data that was given to you in your lecture notes. It's important for us to make sure that when we use FIFO, that the units we have to account for will equal the units accounted for. So we had 800 units in beginning. Inventory, we started 2,200, totaling 3,000 units to account for. Now, as you learned last time, when we talk about where did these units go, what we're going to do for transferred out, we are going to have 2 subgroups. What we transfer out would be first, because this is FIFO, the first set of units to be transferred out would be the beginning, and then those units that we started this period and completed. So this is a special step that you take when you do the FIFO approach to process costing. You must look at the units that were started and completed. So we're told beginning was 800. We were told that ending was 600. We know that the totals have to be the same for these two. So we get 3,000 units here to match the above. And then we can fill in with 1,600 units were started this period and were finished. And again, the other group that was transferred out was that beginning group of units, 800 units. Those were started last period but not finished. But these would be the first things to get finished using the FIFO method. When we use the FIFO method in step 2, when we're calculating equivalent units, we have to consider that our beginning inventory comes to us partially done, and in this case 70% complete as to materials. So we have to figure out how much work we did on these units this period. So 70%, then we must have finished it by doing 30% more of the work. In regard to conversion costs, when it tells us it's 45% complete as to conversion, then to finish this beginning inventory, we had to do 55% of the work this period. Let's talk about step 3. And step 3 is really nothing new here. You're just going to summarize all the cost that you have to account for. So this is just really not going to be any different than what we did before. Let's go to step 4 though. Something does change. In step 4, we calculate the cost per equivalent unit. And unlike weighted average approach, the FIFO method is only going to include current cost in this calculation. The reason this is true is because we will be isolating, as you've already seen, that beginning inventory and keeping the cost associated with those beginning units separated from the costs that relate to this period. So current cost only. Let's go on now. Finally, step 5 is where we assign the cost. And just like always, we're going to assign the cost to the units transferred out and those that were not transferred out. But now we have to look at 3 categories when we go to this assignment to units transferred out. We have to include beginning inventory cost. Remember, we haven't included that in our calculation of cost per equivalent unit. So we're going to directly assign those costs to the units transferred out. Whatever we had dollars in beginning inventory is going to be assigned to transferred out units. Secondly, we're going to have all those costs to complete the beginning inventory. And we've kept track of that by the way we calculated our equivalent units back in step 2. Thirdly, we're going to have this group of started and completed units, and we will be assigning the cost of these started and completed units to transferred out. So in essence, this is a bit more complex than weighted average because the transferred out would include the costs that were already attached to the beginning inventory and the cost this period to finish that beginning inventory and the cost to start and complete the number of units that we calculated in our first step. Let's go back and look and see what that was. It was 1,600 units. So the cost of doing the start and the completion of those units gets assigned to transferred out as well. The last thing I ask you to consider would be what type of company should use FIFO. And let's talk about that. Who should use FIFO when they do process costing instead of using weighted average? A company that has a large beginning inventory relative to the units that it starts would be a good candidate for using FIFO. Because remember, the difference between the systems of weighted average and FIFO, the big difference is how we treat beginning inventory. So if this is a real large amount, it's going to be important that we use the FIFO. Secondly, if we have a company where either the price of the units produced or the cost of the inputs to produce these units is very volatile and subject to change, it would be much better to use FIFO because we're able to separate the cost of this period from next period. In other words, we don't blend the two periods together in a weighted average approach, but we separate the periods. So we would get much better managerial information if we would use FIFO when we have such volatility in either the price of the product or the cost of the inputs. Let's return now to the current module, which is Module 9, and is about joint costing. I'd like us to look at some slides for this lecture because the visual presentations in these slides, I believe, will be very helpful as we begin to discuss the terminology that is associated with this subject of joint costing. Please note that these PowerPoints are also available in the content of Module 9. So let's look at the first slide, and in this slide we'll introduce you to two different terms. First of all, joint cost. Joint cost means that we have a single process, but this process yields multiple products. And in this case, the yield would be 3 different main products. So all these costs that you see in the green area, these inputs, are shared by these 3 products. The point at which these 3 different products emerge is referred to as the split-off point. In this next slide, you're seeing the common production process, which is where the joint costs are incurred, and we have a split-off point. And we see oil and gasoline emerging, but we also see that these are intermediate products. That means that they are not sold at the split point, but require additional processing. When they get this additional processing and are in a condition to be sold, these are then considered to be final products. It is possible for products to be sold right at the split off point. But in this particular slide, these two products cannot be sold until additional processing occurs. Certain products, again, they could be sold at the split point or they could be processed further, and there has to be some kind of decision rule for how we determine if a product has that option. It can be sold at split or processed further and sold. What is the decision rule for whether we should process further or not? Well, what we have to immediately recognize is that these joint costs that you see in this single process, these are what we would call irrelevant costs because they're sunk costs. They have nothing to do with the decision to process further or not, because if we process further, we're going to be far to the right and we're going to be moving this product from an intermediate to a final product. And all this process cost, these joint process costs on the left side, are truly sunk or irrelevant. The decision to process further or not is really a function of the incremental revenue or incremental costs that we will incur from the additional processing. And let's look at the example here. This truly is the decision point. If we have incremental revenue exceeding incremental costs, then we should process further, because that will result in what we're going to call incremental profit. If the incremental costs are more than the incremental revenues, we would not want to process further because this would cause us to incur a loss. So let's find these terms in the example here with the lumber. If we sell at the split, we sell for $140. If we process further and sell it further, it will receive revenues of $270. So this difference in the sales price from one point to the next is called the incremental revenue. Now, to get the product from being at an intermediate stage to becoming a final product costs $50 per unit. Incremental revenue, $130. Incremental cost, $50. Incremental profit, $80. The decision based on the numbers only would be to process further. Now, when we look at the wood chips, we have to spend $20 more to do the additional processing, and yet we only get incremental revenue of $10. So the decision here based on the numbers only would be to sell it at the split and not process it further. When we have joint costs, there's a very important point to make, and that is these joint costs are going to be spread among or allocated to only the main products. So if we have 3 main products, we have to choose a method to allocate those costs to the product. 2 general approaches are taken. You can use what we see on the left, which is the physical measure method, and this would be based on pounds or volume of product, and we would, of course, allocate more to the product that had the greater volume. But another way to do it is to base it on the net realizable value of the product at the split point. And this is called the monetary measure approach. And a key word here is net realizable value. It's very, very important that we understand what a net realizable value means. A net realizable value, or the NRV, is the final sales price, wherever that is, if it's at the split or if it's at the final destination after additional processing, whatever the final sales value is, minus additional processing cost, if there are any. So this way we can compare products that are processed further to products that are sold at the split based upon this definition of NRV. So what we're doing is trying to find the value of all the products at the same place, which is the split off point. Let's look at this example. We have joint cost of $500,000. This is the amount to be allocated. If we're going to use the NRV method, since both of these require additional processing, you will take the $500,000 minus the additional $200,000, and you'll get NRV of $300,000 for the oil. The sales value of the gasoline is $1.2 million. You subtract the additional processing cost, and you get $700,000. So in this particular case, 30% of the joint cost will go to oil, 70% would go to the gasoline. And we can see the calculations here. This is the NRV. This is very important that we understand how it is calculated. We're getting all the products back to the same point, looking at their NRV, so that we can figure out what percent of the total NRV each product represents. So as you can see, 30% of $500,000 will go to oil, be allocated to oil, and $350,000 of these joint costs will go to gasoline. Now, what is appealing to many businesses or organizations about this type of method is that it results in an equal gross margin percentage for all the products. And so the relative profitability of each of the products is maintained by doing the allocation this way. And this has a great deal of appeal. And you can see how these calculations demonstrate that continuation of the relative profitability of each of the products. The physical measures method is, instead of based on the NRV, is simply based on some kind of volume or weight. In this case, it's gallons. So the company that has more gallons in output is going to get more of the cost. And again, very simple. We have 600,000 gallons, and the oil represents 40% of that, so they'll get 40%. The difference here is that the relative profitability of each of the products is not maintained when you use the physical measures method. We also have what we call byproducts in situations of production, where we produce main products and then we produce these incidental products. For example, if we are producing, let's say, wood products, we have wood chips and we have lumber as our two main products, we may have sawdust as a byproduct. The key point is that joint costs should never be allocated to any products beyond the main products. And this is why you see the X over byproducts. Now, even though this is an incidental product called the byproduct, it does end up with favorable or positive proceeds. In other words, we do get proceeds from selling these byproducts to a customer. It may be a small amount, but it is positive. And this is how we determine if something is a byproduct or a main product. It's really is determined by how significantly the product contributes to the overall sales of the company. And in this case, the sawdust is a small amount relative to the other two products. Another example might be if you had a butcher shop and you're making all these different cuts of meat, packaging different cuts of meat, you will have dog bones that result, and these are sold, and there's a positive but an immaterial amount of proceeds from selling these dog bones to the grocery stores. So this would be another example of a byproduct. There are two ways to account for these byproducts. Remember, we do get positive results for them. We do get proceeds. In number 2 example, what we're doing is we're taking our joint cost and we're reducing them by the amount of the proceeds that we get from the byproduct. So this is one approach. Approach number 1, instead of using the proceeds to reduce the joint cost, the proceeds are going to be shown as other revenue in the revenue section of the income statement. So in either case, the gross margin remains the same. There is one category of product that results from these joint processes, and that would be what we would call waste or scrap. These aren't really products. They're just kind of some additional costs that we're going to have because waste or scrap occurs through these processes. What happens in the case of scrap and why this is different than byproducts is that there are no positive proceeds from the scrap. In fact, it's going to actually cost us to get rid of the scrap or the waste. And so because it's going to be a cost rather than proceeds, what we do with that is we simply add that cost of the waste or the scrap back into the joint cost. And of course, this will end up increasing the joint cost, and all of this then will get allocated to your main products. So the way this is done is very difficult to actually measure the waste or the scrap. So this is usually done through management's estimation, and is part of producing product is to have scrap or waste. And again, what it is, how we handle it is it just adds to the joint cost, which are then allocated only to the main products.